Today, I'll just run through some of the key picks in my coverage universe for 2021. I'll start with Amcor. We've got an ad rating on Amcor with a 17.80 target price. I still really like Amcor. It's run by, as you all know, a very good management team that is highly regarded by the market. It's obviously got strong defensive characteristics with over 95% of its revenue generated from sectors such as food, beverages, personal care, healthcare, and tobacco packaging. And importantly, Amcor has been recognised as an essential service in all of the 43 countries that it operates in. And hence, despite the ongoing spread of COVID-19 globally, its operations should largely continue unaffected. From an earnings perspective, things are going really well as well. The first quarter 21 result was well ahead of ours and also market expectations, and that resulted in FY21 earnings guidance being upgraded. The key risk, however, and this likely, I think, explains some of the share price weakness over the last couple of months, is currency. Given Amcor does report in US dollars, a lower US dollar is positive for earnings translation, but it is negative when we convert our US dollar valuation back to an Australian dollar target price. So net, in terms of sensitivity, a 1 cent decrease in the US dollar against the Aussie dollar and also the euro decreases our valuation on Amcor by around 0.5%. So just keep that in mind. But overall, I still really like Amcor. The fundamentals of the business remain strong, but with the current trend in the currency, I think that could weigh on the share price in the short term. On Brambles, very similar to Amcor, it does have strong defensive characteristics and is mostly exposed to the grocery sector. It's a very reliable, dependable business with very dominant global market positions. However, similar to Amcor, it does report in US dollars, and a lower US dollar will be a headwind for Brambles. The stock closed at $10.48 yesterday. We do have an ad rating and a 12.16 target price on Brambles, but I think, and given some of the short-term headwinds, I think if the stock were to drop, say, below $10, around that maybe $9.50 to $10 range, I think that'll be some decent buying there. Invocare, I've got an ad rating on Invocare with a $13 target price. Ironically, COVID has been a negative for Invocare with more people staying at home, better personal hygiene, and virtually no flu cases this year, resulting in a lower number of deaths. Restrictions on the number of attendees at funerals has also been a negative for revenue for Invocare, given that they've been unable to offer their full range of services. So the last 6 to 9 months haven't been great. But I think if you are looking for a stock with exposure or benefits to that reopening trade, so a reopening of the economy and also a potential beneficiary of a vaccine, oddly enough, I think Invocare definitely looks interesting. It is still underneath a very good business, and I think the longer term drivers remain strong with a growing and an aging Australian population. On Coles, I've got an ad rating on Coles with a 19.40 target price. The supermarket in general, as we all know, has been a key beneficiary of COVID, with more people eating and drinking at home. And with international borders shut, obviously no one is travelling overseas at the moment, and hence a lot of people are actually spending Christmas and New Year's, or have spent Christmas and New Year's in Australia, which is good for Coles and Woolies. And I was looking at some recent press reports, and it looks like the Christmas trading period for Coles and Woolies were actually pretty strong as well. So that bodes well for the result next month. Obviously, we're also getting COVID flare-ups in certain areas, especially in New South Wales, and that is resulting in some panic buying and also some pantry stocking, and that's also another positive for the supermarkets. So overall, I think the sector in general should continue to do well over the next 6 to 12 months. But in terms of preference, I still prefer Coles over Woolies, given it is trading on a more reasonable, on a lower multiple, so hence a more reasonable valuation, as well as it offering a higher yield than Woolies. And then moving on to some small cap stocks, I still really like PWR and also Acrow. PWR, obviously a high quality founder-led business with a strong balance sheet and also a strong track record of growth. It does look like that growth, will continue for at least the next 3 years. So I think it's more a matter of picking your timing with this stock. Just note, however, that a higher Aussie dollar is a headwind, with the majority of PWR's revenue generated in British pounds or US dollars. So I think in the short term, I think you just have to pick your entry point. I think you have some time to get in. But I think if you can get PWR, say, close to the $4 mark or even below, I think that looks really good buying for a high quality business. And then finally on Acrow, it is only an $85 million market cap company, so I understand it's not for everybody. But I think it's run by a very, very good management team. It's got momentum, positive momentum recently with some really good contract wins over the last 6 months. And it's got leverage to growing demand for infrastructure investment. And I think that should remain strong for at least the next 3 to 5 years. The valuation is also very reasonable. It's trading on about a 9.5 times FY21 PE. You get a 4.5% yield with that. And it's got a good balance sheet. So I still think, around these levels, I think it still looks good buying.